You're all very welcome to today's session. My name is Ellen McElroy. I'm Regional Manager here in Irish Pensions and Finance, and I'm joined by my colleague, Senior Financial Advisor Tom Corcoran.
Thanks, Ellen.
You're very welcome to today, Tom.
Thank you. Looking forward to it.
I think between the two of us, we've over 30 years experience in the industry, so there you go, we're part of the furniture, Tom.
Starting to feel old now, Ellen.
But look, Tom, I'm delighted you came on board with all your industry experience. Today, we want to have a really detailed look around the area of charges.
Sure.
On pensions in general. And at IPF, I suppose it's important that we welcome a really robust discussion around charges and what's in it for the client and what's under the bonnet of the different types of pension plans that might be available to you. More importantly, what do you get for those charges and how are they structured? Okay, so Tom, look, you've extensive industry experience at this point. You deal with clients day in, day out, building plans. Take it back to, I suppose, the beginning of a client's journey or somebody contemplating taking out a pension plan.
Well, I suppose the first thing to note, Ellen, is that we actually don't charge to have an initial conversation, okay? So if we go back to the beginning with a client, we'll have an initial consultation. Most of our clients will be in the public sector. So what we'll do is give them an overview of their superannuation scheme, show them how it works, look at what figures they're going to get at their retirement age, and then work a plan around that, initially. Okay,
so as you mentioned, look, at IPF, our flagship product are ABCs in general, but this generally will apply to any kind of pension plan you might take out. But what's important to understand when looking at a pension plan?
Well, I suppose the first thing looking at a pension plan is, firstly, do you need one? Okay. And also how you're going to draw the money in retirement. Okay. So it's easy enough to say, okay, putting X amount of money into a pension plan, building up a fund, but it's equally important to know at the end of all of that how you're going to actually draw down on your money, how tax efficient it will be for you.
Okay, so you might talk to Joe Bloggs and you might look at his pension working within the HSE, to give an example. And he might look at his options and go, Tom, actually that's very strong, that's very good, I don't need to look at options. On the other side, you might have a worker that has serious shortfalls in their service, wants to retire early, which is a lot of what we would get on a day-to-day basis. So there is a need to maybe look at adding extra towards their retirement plan.
Sure. So quite often when we meet people like that, then our flagship product is the Group ABC scheme. And if you put that in place for a client, that's initially done through payroll. So there's a payroll facility. So if you were to talk about charges and that, there's actually tax relief on charges by doing it through payroll.
Very good. So we will get to that in a little while. But in terms of, I suppose, the amount of experience that you have, what can prevent somebody from getting to their retirement goal?
So quite often we'll find that some people actually get in their own way of retirement. So what I mean by that is they might not take an annual review, they might not review their plan for over 10 years.
Wow.
And quite a lot will have changed potentially in those 10 years. Firstly, in their own circumstances may have changed, but equally from revenue rules and tax rules, etc. A lot can change then as well. And then what we found, or what I find with clients that haven't reviewed policies over the recent years, is they maybe forget why they've taken out the pension in the first place. They forget the benefit they're going to get from it. They just get used to paying out a premium and forget what that's going to do for them in retirement. And in a lot of cases they're pleasantly surprised that they have started something, they have started contributing for retirement, and it might make it a lot easier for these people then to retire that little bit early. If they want to.
Okay, the pitfalls can be, unless you're getting your regular advice, as you mentioned, they might put extra money in that they don't need to, or they might stop it.
They might stop it, and quite often we've dealt with clients more recently that have been advised by their existing providers to actually stop paying in once they've reached the tax-free lump sum threshold. And that might be a good advice for them, but quite often when we explain, look, there's an additional pension income you can take, and at a tax efficient rate, they're usually then saying, well, why was I told to stop paying in? And sometimes that doesn't make sense. So the wrong advice, can be very detrimental to the outcome at retirement.
Okay, so back to kind of getting the regular reviews and professional advice
Absolutely.
Along their journey.
Absolutely, professional advice is needed. Again, we often find people saying that, okay, my colleague joined the same time or similar time as I had, a similar service, this is their situation. Well, that might not necessarily be the same situation for you.
Yeah.
So we need to tailor a plan for you as the individual based on your circumstances.
Okay. And actually, Tom, just on that point, it's a very good segue. Just reading an article on Brokers Ireland on the value of advice. This was published in May 2025. And the results found that those who seek regular advice have 45% larger pension pots, they've 71% more in their savings and investments, and they're 52% more likely to have greater financial protection. And those are startling stats, aren't they?
They're serious figures, but you can't argue with them. And look, like yourself, been in the industry a long time, you'll see that, you know, and you do meet clients that you've met a number of years ago, they've put a plan in place, and when you go to review it, you know, within, let's say, 5 years later, they're in a much better financial position than they were before they took the advice.
For sure. And like, if you looked at you and me, Tom, 20 years
Yeah.
ago, we had no children, and now we've got 6 between us.
Look at, yeah,
So-
indeed. Yeah.
So life does move on, and life
Sure
does change.
Sure does, Ellen.
Okay, so we've discussed around the importance of that regular advice and keeping the plan on track and looking at the goal and getting what you need. So how do charges loop in with all of this, and why is it important that a client is aware of all their charges on a plan?
I suppose it's very important. Like with any pension plan, there's going to be charges. Okay, so there's no one size fits all kind of approach to this, you know. But it is important that clients are aware what charges they're paying on their fund. And you know, it is also important to know that if they're not paying in, there's still a form of fee there.
Yeah.
You know, so a lot of clients don't think there is when we talk to them. So it's important that they're aware of that.
Okay, so Mary in the HSE stops her pension.
Yeah,
She's still going to pay a charge.
Absolutely, yeah. So
Yeah.
she'll be paying a fund management charge on the value of her fund each year, whether she's paying in or not.
Okay. And I suppose in terms of the service on an ongoing basis, so look, simple comparison, you know, you pay a fee for a doctor or a solicitor or an accountant as a professional service. It's similar enough in the broker world as well.
Yeah, so I mean, there's a broker charge. Like, so we at IPF, you will never be asked to pay a fee, first of all, okay? But some brokers are out there and they will charge an upfront fee, which is their business model. That's what they do. They get paid to give this advice, you know, whether you take a product or not, and that is fair enough for them. But with IPF, we don't charge you to have a chat. But if you do take out a product, for example, the Group ABC scheme, there are charges that will apply to that, and we'll be very transparent in that. We'll show you exactly what the charges are and how they affect you. But like I mentioned earlier, if you do, for example, use the Group ABC, it's gone through payroll. Okay, so all the charges receive tax relief, and if you're a higher rate taxpayer, 40% of all that is paid for you.
Okay, so that's a helping hand.
It really is.
With any charges that you may incur. So just to bring it back to broker fees. So as you mentioned, they're, you know, walk into broker on the main street in Cloney, okay? And you're looking for financial advice, and their fee could be X. Okay, so you're paying upfront before you take out any kind of a product with them. Okay, but you're taking on the advice, and it's fair enough as it is a business, needs to keep the doors open, etc. Whereas the IPF model is you're not charged to speak to a qualified advisor, but there is charges on the products that you may opt for if it's suitable.
Yeah,
that's the difference between
the two. That's the main difference.
Allocation rates. You hear a lot around allocation rates on social media, and I know you're a big TikTok fan, Tom. What is an allocation rate? What does it mean for the client?
So an allocation rate is the amount that's allocated to their pension pot. Okay, so you'll hear a lot about 100% gross allocation rate. What you need to look for actually is what the net allocation rate is. Okay, so at IPF we give you with the Group ABC scheme a reduced allocation rate in year one. Okay, so less of your money is going into your pension in year one, but in year two you get an enhanced allocation rate. Okay, so more of your money is going in year two.
And why is that?
Well, really, initially, it incorporates our setup fees.
Okay,
so we don't charge you a setup fee per se, but the reduced rate allows us to meet you for free. There's no cost to meeting with us. It's only if you take out a plan, then you get this allocation rate. But also the reduced allocation in year one allows us to give you a reduced fund management charge.
Okay, and we can get to that in a minute. Okay, so that's interesting, but where I'm confused is like, surely that's the same as another broker charging
Well,
as standalone fee, and we would charge like a year one fee to set up the plan?
I would say it's not, because the broker from day one will charge you a fee whether or not you take out a plan, okay?
Gotcha.
Whereas with IPF there's no charge. So
Okay.
if you don't take out a plan, you're not out of pocket at all. And then secondly, if you do take out a plan, from day one your money is gaining in the form of tax relief. So with the group ABC scheme, everything is done through payroll. So if you take the person that's putting €100 per fortnight or per month into a group ABC scheme, 40% of that is paid for them.
Okay.
Okay, so that's absorbing charges also.
So they're getting a helping hand in their year one.
Indeed.
Through tax relief.
Yeah.
Gotcha. Okay. Perfect. All right. So let's go back to what you mentioned earlier, Tom. Fund management charge. So back to my previous point. You hear a lot around allocation rates.
Yeah.
Don't hear so much around fund management charges, or AMC, which is your annual management charge, another name for it. So,
Sure.
so what is that?
Well, the AMC or the FMC or whatever you're having yourself is the amount, it's a percentage of your fund that's charged each year that essentially is for the management of your fund.
Okay.
So they can range from 0.5 to up to 2.5% per annum, and obviously the lower the fund management charge is, the better generally the outcome is for the client.
Okay. So where does that go? Where does that, let's say you said from 0.5 to 2.5%. So who gets that? Where does that go?
So that essentially is going to the fund manager,
Okay.
the life company that are managing.
So it could be New Ireland and
New Ireland, Irish Life, Zurich,
Okay.
whoever that is.
Okay.
And at IPF with the Group ABC scheme, we believe then that having a lower fund management fee is going to benefit the client in the long term, because I suppose in year one, when the client is only starting to pay into their ABC, they probably don't have an awful lot there to worry about.
Yeah,
okay?
yeah.
The fund is very small, so their fund management charge is
So it
very
is
small.
quite small, in comparison to say a year one allocation. 0.75.
Yes, indeed.
Yes,
yeah,
yes.
and it looks like the smallest charge quite often, but in actual fact, once the client has built up a fund of money worth worrying about, the fund management charge is actually usually the biggest fund charge they pay over time.
Okay.
So the lower that fund management charge is, the better for the long-term interest for the client.
So the fund management charge is taken on the value of the pot of money they're building up.
Exactly.
Okay, and the allocation is just what you're putting in.
What you're putting in every fortnight or every month. Yeah.
Gotcha.
Yeah.
Gotcha. Okay. So the lower fund management charge over time, and that's a crucial part, isn't it?
Absolutely.
Over time, it will benefit the client in the long run.
It will. It'll always work out better in the long run to have a lower fund management charge than having a higher fund management charge.
Okay. Okay. So what's important for anyone to note is that the higher the fund management charge, that's the bit that's going to keep climbing.
Exactly, because the
As
larger
your
your
fund
fund is, that percentage is coming out every year.
Okay. Okay. All right. And then just the last point on charges, so policy fee. So you get a lot of this on kind of group schemes or schemes in trust. What is
Yeah,
that?
so there's a policy fee at IPF, there's a policy fee, it's a €3.81 per month, and essentially I would call that an administration fee. So a lot of work goes on in the background to having an ABC plan through payroll, so somebody's actually deducting it at source. You don't have to go off and claim your tax relief, that's all done at source for you. Somebody in payroll has to make sure your money is allocated and sent over to the life company, etc. So realistically, it's a fee that's covering the cost of all that.
I have a question for you.
Sure.
And this is something that we get probably on a weekly basis around, okay, so I've built up my lovely fund, I've actually annuity. Sounds attractive. I get my lovely tax relief when I'm going in.
Sure.
But actually, Tom, when I'm pulling it out, it gets taxed.
Okay.
So talk to me about that.
Well, what we find is that most people that we deal with in retirement tend to drop a tax band. Okay?
Okay.
So what I mean by that is quite a lot of people will be high rate taxpayers while they're paying into their pension.
Because they're on full salary and they're earning full-time earnings.
Absolutely.
Gotcha.
Yeah. So they're paying 40% tax. So, and by default they're getting 40% tax relief, okay? In retirement then, they'll usually drop a tax band, okay? So most people that are earning less than 90,000 per annum will drop into a lower rate tax band at retirement, okay? And that means then that they can access some of their ABC when it goes into an ARF or an annuity at the lower rate of tax. We'll be able to work out what that amount is when they're retiring.
Okay. So I have it clear in my head. Okay, so let's say Joe Bloggs puts €100 into his ABC. He gets tax relief at 40%, so actually it only costs him 60. Okay,
Yeah.
to accrue the €100. And then Joe Bloggs retires and he draws out the same €100. But because his income has dropped to a level where he's in the 20% zone, that same €100, he gets 80 back out for that €100.
That's exactly it.
Okay,
He's
so
only paying 20%.
there's still a gain on
Still a gain. But can I just mention in that though, the other gain on that is for the years that he's been paying in to his AVC, any growth in that fund is not taxed. So there are some people out there that will pay into the AVC at 40% and will draw it down at 40% and yet still find it beneficial to do it. And that's more a wealth management situation there, where they're seeing the benefit of all the growth over the number of years that they're paying into it.
Yeah.
That it's not being taxed and that it's only being taxed then as income when they retire it. And when I mention wealth management, a lot of people do this simply to grow wealth, to grow a substantial fund in the knowledge that they're going to leave it to their next of kin. And it's good to be remembered then that if you're used to paying higher rate tax through your earning years, there's no harm in paying higher rate tax in retirement.
It's a good complaint.
You know, it's a good complaint.
Yes.
It's a first world problem, as I would say. You know, it's not a bad problem to have
Yeah,
necessarily.
yeah. And actually, Tom, it's interesting because you mentioned with the ARF, you're invested in retirement also. So you still continue to grow those pots that you've accrued. You just can't add into them. But they will continue to compound on the market. So
that's exactly
it can do quite nicely for you in retirement also.
Yeah, it's a get rich slow scheme.
Okay, very good. Good way of putting it. Right, well, Tom, thank you so much for all the advice. Really found that interesting and useful. So I suppose, look, to recap on today would be the power of advice over time, getting your annual reviews, sticking to the plan, sticking to the process. Understand the charges and understand that they are there, and you know there is a value to the service attached to those charges. And I suppose just again back to that really good report, the Value of Advice report from Brokers Ireland, 19% of retirees who did not use a financial advisor stated that their biggest regret was that they didn't prepare enough in time. So that's our takeaway point. Thank you for listening.